Welcome to Fixated, the Fixed Income Podcast. I'm your host, Elizabeth Moran, Editorial Director of Fixed Income News Australia. Join me as I talk about the latest news, views and education in fixed income investment. I'll be joined by industry experts from Australia and across the globe.
Welcome everyone, it's Ben Reedy here, co-founder of Fixed Income News Australia and your host for this episode of Fixated. I'm joined today by Andrew Thomson, the General Manager of CFMG Capital, a Brisbane-based fund manager with a focus on the private credit market. CFMG launched its first investment fund in 2016 and to date has raised about $163 million of capital from investors. They've got 3 different products in the market at the moment and to date have returned more than $50 million back to investors. Andrew has more than 20 years' experience in the funds management land development sector and it's his second time joining us on Fixated. Welcome back, Andrew.
Thanks, Ben. Happy to be here.
That's all right. The last time you joined us, we had a bit of a high-level discussion about the private credit sector and your new fund, the monthly income fund, which is sort of 3 or 4 months old now. This time we wanted to take a bit of a deeper dive into some of the aspects of the private credit sector, particularly the issue of fund structures. But first of all, let's just have a quick review of private credit. It's undergone a little bit of a renaissance over the last few years. What do you think is sort of driving the interest from investors?
Probably a couple of things. It's a market that's growing, as you said, so there's a lot more options out there. Availability to both investors, but also the willingness of borrowers to take on that private credit market. A bit more education around what private credit is. And then probably most importantly, more and more retail providers. So private credit, 5-10 years ago was probably the exclusive domain for an investor of wholesale or high net worth investors, whereas now it's become more broadly available to retail investors. The minimums aren't 100,000 or 500,000 anymore. They're as low as 5,000. So become much more widely available to both borrowers and investors.
And the role of banks has changed a little bit, hasn't it, in terms of their ability to fund property developments and that sort of stuff? Is it from a developer perspective?
Yeah, I mean, it's like there's 2 facets to that. The role of banks is not, in some cases, not necessarily changed, but borrowers, I guess, have more available options. And through the growth in private credit, the difference in rates or the rate compression in the private credit market has made it a much more attractive option to a borrower than dealing with the traditional banks that, really monopolise that development market for a long time, but can be quite difficult to deal with and have sort of inflexible arrangements and limited understanding sometimes of what they're investing in versus specialised private credit that's investing in real estate or any other, in other industries, often have people with experience on the ground, are better at assessing the value or content of that loan, and are far more flexible and better to deal with for the borrower. And of course, there also are aspects, particularly from the GFC, where there are certain markets that banks don't play in anymore. So there's been natural growth in private credit there. But certainly that growth in private credit, it's not what, some people used to view private credit as sort of lending of last resort, so to speak. You can't get money from the banks, therefore you go to the private credit market and often then you'll pay through the nose in terms of the rate. Whereas now a borrower will even like us, we'll have plenty of banks willing to lend us some money, but we actually prefer to go to the private credit market because of that streamlined approach. The rate compression, the gap in the rate is not significant, and it's a better space to deal with, and you're dealing with probably more educated operations or educated lenders.
Yeah, and look, like we said, the sector's only got incredible growth over recent years, and obviously the products available in the sector aren't all standardised. Even your products, you've got 3 different products. Just give us a quick 30-second rundown of each of the products and how they differ from each other.
Yeah, so we've got our Land and Opportunity Fund, which has been our flagship product for 15 years now, and that's very different to the monthly income fund. But I'll start with the Land Opportunity Fund. That's unsecured private credit, where investors are lending into a product that is then lent via our fund into land development projects at various stages of that project, at acquisition, during construction. They become some of the equity provided during construction, but it's high rate return. It's unsecured, so in layman's terms, it it's a high risk product, and it's significantly different in terms of what the first mortgage product I sort of offers in terms of security, but as a result, it does attract a higher rate. We then, for a period of time, and still have the first mortgage and income fund, and it's not particularly creatively named. It is a fund that pays an income and secured by a first mortgage. It pays a quarterly return. The difference in that particular fund from all our other funds is it's not used for any kind of development. So it's investing purely in an asset. It's secured by a single asset, so it's a contributory scheme. And in that case, for us as a land development operation, we might be looking at a site that doesn't quite currently have the right zoning or the right approvals in place. We're not necessarily looking to land bank it for a long period of time, but we might look to secure a site on the market at an attractive price that doesn't have the right zoning or approvals in place. And then we would spend 12 months, or more in some cases, looking to then get that asset or that project into the right zoning, or get an approval through, our development team would go through that approval stage. And after the 12 months, that asset would then obviously be revalued if it's got an approval or rezoning and so on, and it would actually move into our Land Opportunity Fund. But the beauty of it is it's a low LVR. We would borrow against a single asset. So the fund would be raised against a single asset up to 70% LVR as an as-is, where-is basis. So there's no assumed value increase or no assumed capital gain on that asset. It's all based on its as-is, where-is purchase. And then if we're not to achieve, which hasn't necessarily happened yet, but if we weren't to achieve that approval or that rezoning, well, the beauty is, unless it's gone down in value by 30% over that 12-month period, it's a simple case of selling the asset and moving on to the next one. But on 100% of the ones we've done so far, we've either achieved a rezoning or an approval. The value of the site's gone up significantly. We've paid out investors accordingly, and it's then moved into the Land Opportunity Fund. And the benefit of that, obviously, it's got a new book value. And in the case where, we don't achieve that development approval or rezoning in the first 12 months, we can extend it for 12 months and refinance with new lenders, give the opportunity for with new borrowers or investors, give those opportunity to go again, or if they want to, or pay them out and refinance with new investors. And then the final product, which is the monthly income fund, it's about 6 months old. It's got about $25 to $30 million into it now. That's been born twofold. Huge demand from our investors for a product that pays a monthly income. So investors that have been with us for 10 to 15 years, some of them moving into retirement, they're looking for a private credit product that's secured by a first mortgage that pays an income from a fund manager or a asset manager like us that they trust. And then secondary, it's become a source of funding for us for our construction finance. So that's a pooled scheme. So it's pooled across all our residential development assets across the country that we hold at any one time or currently operating. It's secured by first mortgages for construction lending on those projects, and it pays a monthly income on the back of being secured, through those assets. So, and essentially for us as a developer, that's replacing, the banks. So we've dealt with NAB, we've dealt with ANZ, Suncorp, Westpac, even Commonwealth Bank in Sydney. They've traditionally been our construction facilities for the actual construction of the infrastructure and the development works in each of our projects. We can now secure that funding through the monthly income fund, while also offering a product that was, strong demand from our existing investor base. And what we've also seen is a lot of investors that have been sort of assessing us as an option, but we're looking for a product paying a monthly income and with a little more security. They've really jumped on board. So it's been probably our most popular product in the last 6 months, and certainly fast becoming our flagship product after 15 years with the Land Opportunity Fund.
Yeah, and what's that currently paying?
That one pays an 8.25% rate per annum. It's an open-ended fund, but you are the lock-in period's the first 12 months. and then you have a 30-day redemption by request after the first 12 months.
Yeah. So obviously there's 3 different funds there, 3 very different structures, 3 very different strategies, 3 very different risk profiles. One of the things you mentioned was a pooled scheme and a contributory scheme. Just quickly give us a quick overview. What's the difference between a pooled scheme and a contributory scheme, and what it means for investors?
Yeah, so for the contributory scheme, it's simple in the sense that you're just contributing or lending or borrowing, or however you want to look at it, against one single asset. So the asset is known. It's a known quantity. You know what the asset is before you invest. Sometimes a contributory scheme could include multiple assets, but they're all known, they're all already acquired, they're already identified at the time of investment. Whereas a pooled scheme is exactly as it's described. It goes into a bucket, so to speak. There might be known assets already, but essentially you're putting your trust in the manager to then go and invest the money out of that bucket or out of that pool of funds into assets or projects or whatever, what have you, into things that meet the investment criteria that they've published in their PDS or in some of the documentation or discussions you've had. So contributory schemes generally are single asset. Pooled schemes are obviously not single asset and are pooled across a network of opportunity and diversified across a network of opportunities. There are pros and cons to both. If you know the property market or you've got, greater knowledge than the average Joe on the street, and you know the asset, well, you might be more comfortable with a contributory scheme once you've assessed that asset and all the information about that asset. Whereas if you're looking for a manager to manage your funds for you, or place your trust in a manager, obviously the pooled scheme is something that might interest you. Generally speaking, contributory schemes aren't open-ended. They have a time life or a shelf life because they have a single asset, whereas a pooled scheme, you can continually sell assets out of the fund and add assets to the fund. And certainly in terms of market acceptance from rating agencies and financial advisor networks, the pooled scheme is definitely their preferred option.
One of the things you briefly touched on was the sourcing investment opportunities. There's a lot of people in the sector who will raise capital from investors. They'll go out and assess a universe of different projects, different property developers, pick the eyes out of it, so to speak, find the best ones, and that's where they'll allocate the investors' capital. CFMG is a bit different in terms of the fact that you guys only invest in your own projects, don't you? Is that the case?
Yep, that's right. So it's a very through the line process. So for a project or offer or an asset to make it into our monthly income fund, which is the pooled first mortgage scheme, generally speaking, it's already been in our land and opportunity fund, and it may have also been in our first mortgage and income fund. Not always, but generally speaking, always in the land and opportunity fund. So we've already assessed it, almost created this asset from an embryonic state. We've assessed it as a raw land site. We've done detailed analysis. We've invested significant equity of our own into the acquisition of the asset, and then also the approval process. It's not a matter of just ringing up council and asking for an approval. There's a lot of work that goes into that process, in terms of town planners and other consultants, engineering, and everything in between. So for us, we've got unique, detailed knowledge and aligned interest with an investor when an asset goes into that fund. So we're not a middleman clipping the ticket. We've already got significant equity in every project before it makes it to the monthly income fund.
Is there also much more transparency in terms of the risks associated with each project and being able to manage those risks? All these sort of these underlying investments, some of them go to plan, some of them don't go to plan. How do you sort of manage that when things don't go exactly to plan?
Oh, look, absolutely. Having been on the other side of this, I guess, in a previous employer, we had a private creditor investing in a project. I would submit reports, or, when I was sort of in my early 20s, submit reports that would go up the line to that private creditor. And then, a couple of months later, I might see that report and a fair bit of stuff I put in there is not in there. And it's not necessarily they're trying to be dishonest, but they've got solutions, but they don't want to alert the lender to any potential problems. And generally speaking, that those things sort themselves out. Whereas for us in our position, we've got complete knowledge of every aspect of the project from start to finish, from top to bottom, and there's no surprises. We know what's going on in each project, any challenges we might be facing, what we're doing to overcome those challenges. And there's certainly no surprises. Whereas, in the investor space, if you're just a lender that's gone out and lent money to a developer, who's presented a project that you think's profitable, you're reliant on them giving you the information each month. That typically there'd be a PCG meeting of some kind, or certainly a reporting process. But you're not living the project. You're not in that business. You're reliant on the information they supply you.
Yeah. So that's obviously the management process once you've identified the project. Talk to us a little bit about how you identify projects and what that process is in terms of, I noticed you bought a block of land at Rochdale recently. How do you go about that, assessing whether a project has got a good opportunity to deliver a long-term return for the investors?
And for us, in terms of land development, we're not pretending anything other than that we're pretty stock standard and vanilla in that space. We're not reinventing the wheel. We look at a project holistically. We'll look at it where it's zoned, likelihood of getting a development approval, what's creditable and uncreditable in terms of infrastructure development, what the demand and supply situation is in that market, essentially what the price we can acquire it for is pretty important. And then we would generally, certainly we're pretty conservative. The main question we ask during that process is, will this project deliver us a return at or above, an acceptable rate that we're going to pay our investors? And if the answer to that is yes, then obviously we can go to far more detailed analysis, which is, every project's different, but flooding, bushfire, ecology, environmental, engineering, every single different site has its challenges, and it is important, certainly, and that's where it's a challenge for another fund manager is they don't know how much assessment has gone into it, or is we're doing that on the ground, we're doing that assessment before we've even got to that point. But some projects are tick and flick. If only they were all like that, but certainly the challenges you can face in a development site, where we've experienced or seen them all. And sometimes if we see a challenge, we're prepared to take it on. We see a challenge and we walk away from that, site. We're assessing in excess of 100 development sites a year, and, we're only buying 5. So we're not buying everything we look at, that's for sure.
Yeah, and it's about whittling it down, that universe of 100 projects down to the 5 that are the 5 best.
Oh, and look, at the end of the day, out of those 100, 50 might suit us, but 45 of them, someone's prepared to pay more than we were. So there's that's also one of the challenges. And, you certainly don't want to get in a bidding war with someone who has a greater appetite for risk than you.
Now, talk to me a little bit about interest rates. Obviously, we've been in a interest rate cycle where interest rates have been going up, or they've been steady for close to 12 months now. And before that, we had an interest rates rising pretty steadily. The expectation is that rates will start to fall either later this year or early next year. How does that sort of affect the funds? And to another degree, how does that affect the market for land?
Oh, yeah, 2 parts to that question. So in terms of the funds, I think it makes our suite of products slightly more attractive to investors. Certainly over the last 3 to 4 years, as term deposit rates, things like that, crept up, into the nearly 7s, I think, at one point, when we're out there offering 9s, early 10s. Suddenly that gap's not huge. So obviously at term deposits, I wouldn't say it's not a guaranteed return, but it's as close to a guaranteed return as you can get. So, we want that gap to be a little bit wider to make our products more attractive. Whereas I guess in the land market or the sale of our end product, the interest rates coming down will just broaden the demand, I guess, for new residential land and new housing. So at the moment, demand's significantly outstripping supply anyway. But the first home buyer, certainly in the inner, well, not just inner city, but even the suburban areas of Brisbane, Melbourne and Sydney, first home buyers have pretty much been priced out of the market at the moment. You can't, even in sort of the outer ring suburbs of Brisbane, up Caboolture, Logan, those sort of places, you're not getting into a house and land package for under $750,000. And the borrowing capacity of your average first home buyer including, the requirement to have saved up a pretty significant deposit, just doesn't get there at the moment. So they're priced out of the new market. They're typically a first home buyer now, almost despite the first home buyer grant availability only being available to new house and land. Generally speaking, from an affordability perspective, they can only buy existing secondhand stock. There's exceptions to every rule, but generally speaking, first home buyers have been priced well out of the new home market at the moment. And I can't see new homes and new land prices coming down in those outer ring suburbs, let alone inner ring. So it's a borrowing capacity that's going to need to go up for them to become an option for them. So at the moment, it's more second home buyers, downsizers, and then a strong. There's still a huge demand for investors to buy this sort of stock, because at the end of the day, landlords have got a bad reputation at the moment, but people have got to find somewhere to live. And with migration the way it is, both particularly in Queensland, interstate migration as well as international migration, demand is outstripping supply significantly. And there's a lot of work for government to do for supply to catch up, because the developers can't do all the heavy lifting.
And when do you sort of think interest rates might start to move a little bit? Do you think this year or next year?
Oh, look, I think probably next year. We've obviously got some state government elections coming up, which probably won't move the needle too much or have any impact on that kind of thing. But I think, there'll probably be some more inflationary pressures as we come into Christmas. I mean, the funny thing is it doesn't seem to have the RBA movements of the rates, doesn't seem to have the same impact it once did as a lever against inflation, because, there's a lot of people out there that hold mortgages where the rates going up isn't affecting their spending rates at all. Certainly, I'm not going to dob baby boomers in, but older generations have got, ridden the wave of property cycles going up and up and up. The equity they hold in their property is, there's generations of Australians with either got no mortgage or their LVR is probably 10, 15, 20%. So rates going up isn't affecting their lifestyle really at all. And then certainly with the landlords, they just pass it on to their tenants. So, and obviously rents going up is part of that inflationary pressure. So not sure it's having the desired effect it once did, and they probably have to find other structural ways to keep inflation in check.
Yes, I don't think we're going to solve that problem today.
No,
that's for a bigger discussion.
Yeah.
Right, Andrew, thanks for joining us today. That was great to hear a little bit of an update on CFMG and different products. We look forward to having you back again in the future.
No worries.
Thanks.
Thank you for joining us this week on Fixated, the Fixed Income Podcast. Still hungry for more fixed income news, views and education? Then visit fixedincomenews.com.au and don't forget to subscribe to our newsletter to have the latest news delivered right to your inbox. Thanks again for joining us. I'm Elizabeth Moran, and we'll see you next episode on Fixated, the Fixed Income Podcast.